It's an enormous privilege to welcome you all to the 33rd Annual Marine Money Week. We hope you're all safe and well, and I do wish we were all together at the pier. It's a stunningly beautiful day here, and Lorraine and her team have promised that they will be similar next year when we're all together again. So while the physical absence is trying for us all, not the least from missing the outdoor meals with friends, the chance encounters on Park Avenue, huddling around deal room tables, and late evenings at rooftop bars, I miss that last glass Chris enthusiastically encourages year after year. But as the enthusiastic chronicler of our industry's commercial and financial achievements, I can honestly say that the creativity, pace, and transactional execution you all continue to produce under such challenging times inspires us. Thank you for that, and for the emails and the calls, all of which mean a great deal. I would also like to thank again all the ship owners and managers who have worked so long and tirelessly on behalf of our industry's essential colleagues, our seafarers who throughout the pandemic ordeal have kept the world's logistics pipeline going. While nations, each in their own state of pandemic despair, have often deserted their seafarers, I am humbled by and proud of all of you out there who have not. And I'm pleased to make a small donation to the Seamen's Church Institute, of which I'm a board member, for their support of seafarers during bingo on Thursday, which I hope you'll all join us with. I look forward to the next discussion among some of the most accomplished members of our industry who have supported us literally almost from the start. Thank you, and thank all of you for joining us. I'll now turn you over to the manager of our Singapore office, Andrew Oates. Enjoy the seminar, everybody.
Thanks, Jim. Hello, everyone, and welcome to this webinar, Driving Cyclical Shipping Opportunity. I'm your host, Andrew Oates, and today I have the real privilege to introduce our speakers, starting from our moderator, Mr. Benjamin Nolan, Managing Director of Research at Stifel, Mr. Hamish Norton, President of Star Bulk Carriers Corporation, Mr. Ulrich Anderson, CEO of Golden Ocean Management, and Mr. John Wobensmith, Genco Shipping and Trading Limited. With rates and values depressed and Chinese demand growing, 2020 may mark one of the best entry points into the dry bulk market in recent memory. But not all ships are the same. In this session, CEOs of leading U.S. will talk about the businesses, strategies, and outlook for a cyclical upturn in a supply-constrained market. Before I hand over the floor to Benjamin, a couple of ground rules. The audience will all be on mute during this webinar to ensure quality control. And during the webinar, you should have a control panel which pops up on the right of your screen, as is shown here. There are two actions you can take today. First is to ask a question. To do this, you need to enter your question in the box at the bottom of the control panel where it says questions. I will receive them, and at the end of the webinar, I will ask the questions on your behalf. The second major action is to collapse the menu by clicking on the little arrow on the top of the control panel. So we will be running a poll today to engage our audience. So Ben, whenever you're ready to launch the poll, let me know. We can either do it now or sometime during the session. What do you prefer, Ben?
Okay, Andrew, why don't you go ahead and launch it, and I'll explain it while you do the technological side. First of all, I'm pleased to be here, and but the poll here, the question I believe is, has the dry bulk market bottomed? We're going to take this question now, and I believe maybe we'll ask it again at the end and see if opinions have changed. But hopefully you can all see that. Although I might be having some technical issues. Hopefully, no, there we go. Good. So I'll go ahead and begin our session while you all are taking the poll. And again, it's my great privilege to be here, and thank you to Marine Money again for your willingness to include me as part of your the Marine Money Week, and obviously it's a little bit different this week. Although for some of us, this whole coronavirus thing hasn't really changed anything. I know for myself, it's, business as usual, as can be apparent. But the same might or might not be true in the longer term of the dry bulk shipping market. And hopefully that is what we will be getting to here with our distinguished poll members. I do from the outset want to sort of preface this by saying that it is not my intention to really just ask softball questions. The three members of the panel here represent three of the very largest dry bulk shipping companies in the world and are the very definition of the big leagues. So, hopefully some of these questions will be a little hard hitting and cause some discussion that is not just simply cheerleading, but nonetheless, I believe the poll is up and running. Let's go ahead and get it started. And first of all, let's start with a little poll of our own amongst the three panelists here. Same question to all of you. How many of you believe that the dry bulk market has bottomed and is headed up from here? Okay, Hamish, John. Oh, okay, it's unanimous. Good. Now, I'm gonna change that question a little bit. For each of you, how much of you feel that way primarily as a function of supply versus primarily as a function of the outlook for demand? So not as much a yes or no question here.
Well, I mean, my own sense is that demand is picking up. In fact, demand seems to be picking up fairly rapidly. Particularly iron ore movements seem to have picked up. Both from Australia and Brazil. We're not seeing as much pickup in coal, but grains also are picking up pretty well from South America, and we expect the U.S. grain season to be good. But basically, spot movements of iron ore and grains seem to be doing a lot.
So that's a demand vote for Hamish. Okay.
Yeah, I think it's two things here, both are at play. In the short run, we have, as Hamish says, definitely more demand, but in the longer run, and I'm talking about 6, 12, 18 months down the line, we also have a very positive supply situation with a historic low order book, which is front-loaded, of course. So 2021, 2022 looks extremely attractive at the moment, and difficult to see a lot of ordering given the current environment, but also due to the question marks hanging over technology and regulations in general. So positive on both, but right now in the short run, I think it's the demand that's the driver.
Okay, so I'll call that a demand vote.
Both. Okay.
All right. What about you, John?
Yeah, look, I think it's both. I mean, I think the industry has had supply issues that really started back in 14 and really saw 15 and early 16 create problems. I think all of that's behind us. I would love to have seen more scrapping over the last few months, but obviously with the lockdowns that didn't occur, though we are starting to see that pick up pretty significantly. And as Hamish said, on the demand side, you're finally starting to see underlying demand increase, mostly led by China. And we still have Brazil lagging from a supply standpoint and logistical issues, but that seems to, over the last couple of weeks, start to unwind. And you look at where Capesize rates are today, from an index standpoint anyway, they're close to 15. That's come up rather rapidly over the last month. But you got to keep in mind, we still don't have these, what I'll call fringe dry bulk trades back in working order yet. And what I mean by that is Japan iron ore imports, coal shipments into India, Europe fully opened up. So there's still more to occur, even with China trying to import as much as they can right now.
Okay, so we'll call that, I don't know, we'll call it supply just to try to balance things a little bit. But I think from my perspective, supply is a lot easier to get my hands around. You can look at the order book. You can look at the average age of the ships, and it doesn't seem like supply is likely to be a substantial problem, or actually be potentially a strong beneficent or drive more positive supply and demand fundamentals or supply fundamentals here. I think the real question mark, and this is for investors as well as I think anybody else, is the demand side. The three of you are all pretty optimistic on the demand side. This question sort of relates to digging into that a little bit. And the classic axiom has been that when the United States sneezes, the rest of the world catches cold. I think it is probably fair to say, given how big of a player the Chinese market is in global dry bulk business and imports, that can be for dry bulk shipping. It's when China sneezes, the rest of the world catches cold. How dependent do you think that demand story is on a healthy and growing Chinese economy, versus the other 60% or so of the world in terms of dry bulk trade?
I think it's highly dependent. There's absolutely no doubt, right? I mean, they account for 70% of iron ore imports and 35% of the entire dry bulk trade. And, China has clearly led us, at least the beginning of it. We'll see where things go, but they're leading the dry bulk industry out of the short-term recession that we saw in the first part of the year. No doubt about that.
Yeah, I mean, we're lucky that China is probably the economy that's dealing with this COVID-19 pandemic the best. Another statistic, their market share of steel production is in excess of 50% globally. And steel production is really the main driver of dry bulk trade. Yes, we're very sensitive to China. That's the bad news. The good news is, China has been the best economy to be sensitive to in this cycle.
So a question that I would be and have been asked by investors is, all right, this dry bulk shipping trade and rates are highly sensitive to Chinese economic conditions and demand. Does that mean that the dry bulk shipping equities are purely a high beta proxy to the industrial development in China? I don't know. How would you guys answer that question?
Well, I mean, half of steel production is outside China. 70% of grain imports go to other than China. 80% of coal goes to someplace other than China. So, we're sensitive to the world as well as to China.
Okay.
No, I think that's right. I mean, just go back to what I was saying earlier. 35% of dry bulk demand, right, is Chinese related. So as Hamish said, there's another 65%, right, that's going to other areas of the world. India being a big part of that, but Japan, and quite a few countries in Southeast Asia, Vietnam as well, particularly on the coal side.
Okay.
Yeah.
So
Then of course you can't forget about Brazil. Okay, it's a supply situation, but naturally it's a country that we are very much dependent on as well, as we have seen in recent days. Is kind of the reason why we are moving forward on the FFAs and the index. So Brazil we also cannot leave out in this discussion.
Sure. So again, sort of sticking with demand a little bit before we move on to the other facets of the dry bulk business. Is there one, let's say, commodity class, and I suspect it's iron ore. We'll just do it this way. Does the iron ore trade give you the most encouragement with respect to underlying dry bulk trade? Yes or no? Iron ore is what you're really sort of most optimistic about. Let's put it that way. No? Okay, good. What are some other answers then?
I, I, I am most optimistic about the grain trade.
Okay.
But you know, sadly, the grain trade is not what drives rates. I mean, it's very helpful for the smaller ships.
Yeah, I think that's right. The only thing that that I hesitate a little bit on the grain trade is that it's a finite number. You know, you don't. I mean, yes, we're having a record year in Brazil, no doubt, but it's hard to make a case that the actual volumes will increase substantially like we think iron ore will, you know, over the next 12 to 18 months. And I would also tell you the bauxite trade out of West Africa is really getting geared up. Obviously, mostly going into China. And I'll throw one curveball out there. You know, if Trump is able to get his $1 trillion infrastructure plan through, the backhaul cement trade in the U.S. should take off, right? So there's the outlier right now.
Well, this is the big leagues. Throw as many curveballs, spitballs, change ups, whatever. We'll take them.
Yeah.
All right. So then the fastball I'll come back at you with is, what about coal? We haven't really talked about that. I mean, I think there has at least been in the media, coal has had a big target on its back for a long time. Still.
Oh, have we lost Ben?
Lost Ben there.
Well, why? I mean, I think we can anticipate.
I think we know where it's going.
how he was going to end the question. You know, I think you know what I see of coal, for example, in China is that their consumption of coal for electricity generation is increasing faster than their production of coal. And so it looks like they're going to have to import some more coal. But, you know, John.
Yeah, and I'll agree. I think that to declare coal dead as a commodity is too early. Of course, I think we all agree it's not the future, and coal will definitely diminish over time, but it's not going to happen tomorrow. So we still think coal will play a role in the dry bulk shipping, but of course it will play a lesser and lesser role over the years. But in the short run, it will still be a driver, not the most important one, but it will be a driver.
Yeah, I mean, Ulrich, I think you're right. I mean, I think what we're seeing is a shift of coal demand basically from Europe out to Asia.
Correct.
You know, it doesn't get talked about a lot, but the reality is even in China, there are still new coal-fired power plants that are coming on. Vietnam has shown extensive growth last year and slated for more growth this year in 2021. So as we see the coal diminish from a usage and import standpoint in Europe, we're still seeing growth in India, Vietnam, Philippines, Taiwan, Pakistan, and Turkey. China, I've never looked at necessarily a growth area, but I do look at it as sort of fundamental 300 to 350 million tons a year of coal imports. Obviously, that can slow down at the end of the year with quotas that come into play. But Hamish is right. I mean, there's more electricity growth from thermal coal right now than actual production.
Yeah, I think it's too early to declare coal dead.
Yeah, so Ben came back and dropped off again.
Can you hear me at least?
Yes, we can hear you. Great.
Okay, well, the out here on the farm, I guess my Wi-Fi is not so strong, but oh, maybe you can see me now. Okay, so maybe dry bulk shipping is not dead. I mean, sorry, coal shipping is not dead, and I agree. I think it's in seeing better days. But again, I sort of want to put a what if scenario out there, right? Within the last 3 months, the world has changed in unprecedented and unexpected ways. You know, what if coal doesn't come back? How big of a concern is that for you guys? Again, not saying that it won't, but how do you think the market would respond if it doesn't?
Well, I mean, spot Capesize rates right now are, like almost $15,000 a day. With coal doing what it's doing today. And we're still seeing that Brazil's iron ore production is well below, what they expect in the longer term. So, at least for Capes, they're actually doing pretty well, with coal doing what it's doing. The smaller ships, yes, need coal. They need coal to come back in order to have a decent rates.
I mean, Hamish, you're 100% correct. But Ben, just to go to your actual question, all you have to go back and look at is 2015, right, where China really cut back on imports, and we saw that hit the dry bulk market pretty significantly. Now, a lot has happened between 15 and now, with what we were talking about before, with Vietnam, Philippines, Taiwan, India taking up a lot of that. But if we do see a significant slowdown on thermal coal, I do view that as a negative. But we've also got the coking coal side, which we don't talk a lot about. It's obviously not as big a market as thermal coal, but it's paramount in steel production, and China's importing it, India's importing it in pretty major ways.
Okay. So putting it all together, again, sort of, we'll wrap it up on the demand side, or maybe we'll come back. I don't know. We'll see. But our outside of coal, everybody feels pretty good about sort of underlying demand recovering pretty quickly? Yes, correct? Okay. Hopefully.
Yes.
Okay, good. All right, good. Well, maybe we'll come back to that in a little bit, but I want to now, well, I don't want to spend a lot of time on supply. Again, I think as I mentioned in the outset, it's sort of the most obvious and the least questionable facet, but maybe tying in supply here, how, or maybe as a function of sort of your view of supply and demand, but especially supply. How are you guys feeling about asset values from this point? Again, it really matters to investors because a lot of people look at things like NAV, and so from the perspective of what the ships are worth, given both sort of your views of supply and demand, what's your prognosis there?
To one of you guys?
Yeah, look, I think we've seen maybe a 5% reduction from the beginning of the year to where we are today on asset values, maybe a little bit more on older vessels. One of the interesting things is you would have expected, because there's such a high correlation between freight rates and dry bulk asset values, you would have expected a much larger drop basis where the Capesize market went. Though, having said, there's a couple factors there that I think kept a floor in place, which was this was a demand shock. It wasn't a supply situation. So I think people understood that this was probably more short-term. Demand shocks usually come back a lot quicker than obviously a long-term supply issue that we saw in 15 and 16. The other thing is there just wasn't a lot of liquidity in the market. You couldn't sell ships. You couldn't get inspections done. You couldn't do crew changes. So without having sales actually printed, we didn't see values drop significantly. And now that we're starting to see the beginnings of the recovery, I'm reasonably optimistic that we've seen the bottom on asset prices at this point.
Yeah, it's clear we have reached the bottom. We believe that too in Golden Ocean. I think also just to what John said, that we also have not, and luckily for that, I would say, had many distressed sales to put further, what can you say, pressure, downward pressure on the asset prices. So we think that that it's only up from here.
Yeah, and you know, we've seen the secured lenders, you know, behave in a way so as to make as few ripples in the S&P market as possible.
Well, Hamish, to that end, actually, are there differences in the current environment financially with respect to the balance sheets of companies and the industry as a whole that would lend you to believe that, as Eric was saying, that there are fewer distressed sales and which sometimes can really press the market downward? Do you think things are different financially currently than they were in some of the previous down cycles that help lend support to asset values?
Well, I mean, you know, the industry has had 3, you know, reasonably good years to build up cash. So yes, the balance sheets are much healthier than they were in 2016. But also, the rates were never as low as they got in 2016. We had capes that in 2016 were on charter for $800 a day. And, you know, capes have not hit those kinds of numbers in this downturn. And also in 2016, it was terrifying. Demand was dropping, supply was increasing, and nobody knew when it was going to end. Whereas now, you know, we've got this sort of very identifiable shock, and everybody knows that all we need is a vaccine. You know, it's a very specific problem with a specific solution, and you know, it doesn't scare people in the same way. So
Okay.
you know, I think psychologically it's much easier.
And I agree with you. But again, sort of playing devil's advocate a little bit. What if there is not a vaccine? What if there's another, God forbid, another round of coronavirus and a resurgence and the really poor environment? And granted, it's improved a bit, especially for the capes. But what if we go through another year of average cape size rates below $10,000 a day? What does this industry look like if that were the case? Any thoughts there?
Well, you know, look, from my perspective, the problem we've got in demand is that everybody is waiting for a vaccine. Everybody is thinking, okay, if I can hold out and not get infected until there's a vaccine, I might not get infected at all. Whereas if it becomes clear, hypothetically, that no vaccine is coming, then everybody's going to figure out that everybody's going to get infected sooner or later, or at least get exposed to this virus. My own view is that if it becomes clear that no vaccine is forthcoming, then actually the economy recovers almost immediately, because there's no longer any real reason to avoid getting infected. You know you'll get infected eventually.
Any thoughts from the other two guys? And to be clear,
Yeah.
I think that's an interesting idea. Although again, playing devil's advocate, what if we do go through a time where it doesn't recover? That's sort of the real question. What if? What
This
if
is
it's bad?
what if? Okay, if that happens, it is very unfortunately, or very unfortunate. Of course, we don't want to see this. We hope things are being contained. But of course, does it happen? Then we have a scenario like we had 2-3 months ago. It will be the same all over again. This is the risk. This is the risk that we are exposed to. It's the risk that the rest of the world is exposed to, and there's no running away from that fact. So we hope things will not occur in this like that, and that it will happen again. But it is a risk, of course it is.
Yeah, so
Well,
I agree. I mean, it is a risk, Ben, and look, this is, speaking from Genco's perspective, that's why we have kept such a big liquidity position on cash. It's why we've kept our leverage low. It's not something predictable. I agree with Hamish. I think there is eventually going to be a vaccine. Is it this year? Is it next year? I'm not sure, but I am optimistic that we have some very smart people that are working on this, and a vaccine will appear. I would also tell you, I think countries like China in particular are much more prepared for a second wave than obviously dealing with what happened in the earlier part of the year. And I think that's a positive. I mean, we've just seen, they had 56 cases and they've already tamped down in Beijing very quickly. So I think their response time it's much faster now than what we saw earlier.
Well, and really what I'm getting at is there anything either that has already taken place or that could potentially take place if things don't go quite as planned that systemically changes this industry? Are we likely to see mass consolidation or anything else that makes the future different than the past in terms of the typical cyclicality and everything else?
I don't think so. I think this industry is going to be cyclical for some time. I think consolidation in general, outside of the public markets, I think is very difficult. It's just way too fragmented. I think the top 10 owners still only control maybe 15%, maybe not even that of the entire dry bulk fleet. Clearly, there are still a lot of smaller players that are capital constrained, cash constrained right now. So there could be issues if your question becomes reality. But I don't know if I see fundamental change quite yet from COVID-19. I do think there are more fundamental changes down the road because of environmental regulations and decarbonization. I think that will eventually force quite a bit more change than let's say COVID-19.
Okay.
Yeah.
And well, sorry, go ahead, Hamish.
Yeah, no, I mean, I think the industry remains cyclical, but I think that the environmental regulations that John was talking about, the decarbonization rules, are scaring the ship owner community in a way that's very helpful. It scares people away from ordering new ships because they're worried, I think with good reason, that a ship that they order today that is legal today will not be legal in 5 years when decarbonization rules take effect. In the old days, a ship that you ordered that was legal at the time you ordered it would be grandfathered until it's the end of its remaining useful economic life. Given the political situation that we face today, I think people are afraid for, again, I think good reason, that a ship you order today will not be grandfathered. And when the rules change, that ship will be obsolete. So people are waiting until they have some indication of what these rules will require. And so I think ordering is very suppressed and will remain very suppressed until there's more clarity.
Yeah, I agree, and I think this is distinctively a good thing for the ship owner. I mean, our ship owning model has been under pressure for some time, let's be honest, and I think that this gives us a chance to actually lift the entry barriers. It's going to be much more complicated, the landscape we're going to operate in. You cannot just go, as Hamish says, and pick a vessel off the shelf and run it for 25 years. You need to be very screwed in the way that you use technology, in the way that you decarbonize, and it will give those that are switched on, that have the size and that are following these things closely, actually a quite big competitive advantage. So I think for all of the companies here on the panel today, I think it's a good thing for the industry, and let alone that we also need to lift our responsibility in regards to decarbonize. And I think from a private perspective, I think that's just great. But it is overall a good thing from my point of view.
Yeah, no, I think it's pretty clear that Greta Thunberg should be Commodore of the Connecticut Maritime Association.
Well, we'll see. Maybe that was a message. Okay, so and that leads into where I was going to go next. It seems like from every direction right now, we're hearing more and more talk about ESG push and across the board, whether it's the E, the S, or the G. We began talking a little bit about the environmental impacts and decarbonization. And obviously, I agree. I think it's good that we all make efforts towards reducing our own carbon footprints. But from an investor standpoint, is that something that you guys are hearing from your constituents, your investor constituents, saying, "Hey, we need you to, whatever, publish numbers on your carbon usage or output," or is it more box checking exercise, honestly?
I can take a stab at that. I think that mainly the private investors, maybe not so much yet. I think they are interested in it, but I don't think they go down to that order of details. But it's certainly a trend that we see with the banking, the finance side, that there will be more and more requirements in connection with ESG and with bringing down emissions. And of course, this is another element of what we talked about before. We're going to get a more complex world. You will be able to get better financing, get more competitive finance, which of course in turn will make you more competitive. And this is another element of that. So I think it will spill over eventually also, to come back to your questions, to the private investors to a larger extent. But I'm not sure that they look in our ESG report on every small line, but definitely there is a general trend towards this, and it will only grow.
Yeah, I think Ulrich's right. I mean, we've seen it with a few investors that focus on it, but I don't see it as I don't see it widespread yet. But we certainly we've been publishing our numbers. We just published about a week ago, and the idea is to make sure we're staying ahead, so that people aren't necessarily asking us to do it. And when you say check the box, I don't think it is. I mean, we certainly believe in it, and as Ulrich said, I think it's going to be coming more and more from the institutional side.
Yeah, and don't forget, especially in the dry bulk industry, that the third letter in ESG is governance. And frankly, the thing that we talk to investors about probably more than anything else in the ESG spectrum is governance. Because governance is such an issue in the shipping industry in particular, and I think dry bulk is no exception. So I think investors are very focused on that.
Yeah, I agree. I think dry bulk is actually on the governance side behind some of the other sectors. I think tankers are ahead of us, at least in the public realm. We still have some dry bulk companies that have related party transactions that certainly, to me, don't make a lot of sense in having that in place. But that's slowly changing, and at least for Genco, it's top of the list.
Yeah.
We're asked about it or not.
Yeah, I mean, one has seen so many situations in shipping, and in particular in dry bulk, where managements have taken actions that might not have been taken if the incentive structure was appropriate for the shareholders.
Mm-hmm. Is there anything that can be done to really change the view of investors, or is it just a company by company basis? Hey, here is what we do. Forget everybody else and don't paint us with the same brush. Do you think that's possible?
I think investors are smart people, and eventually they figure it out.
Okay.
Yeah.
All right, good. Well, then I have just a couple more. Well, actually, maybe I'll save those just in case. But Andrew, I don't know if you wanted to, if there had been any questions that came in from the audience that people had wanted to place, or maybe you would want to give the instructions again as to how people can do that before I follow through with further questions.
Yeah. Yeah, thanks, Benjamin. Yeah, so we have a couple of questions from the audience. I'm going to start with a few kind of China-related questions. So one is, do you see the supply chain hubs shifting out of China in the medium term, and will that impact trade flows and actually reduce ton-mile demand?
It's a good question. Did you guys hear that?
I heard it, but I didn't understand. I don't think I fully understood the question.
Maybe I'll rephrase it. With the advent, or perhaps the let's call it nearshoring or onshoring of manufacturing, a systemic risk to dry bulk should, the U.S. start to produce its own steel versus importing it from China or, Europe or what have you. So effectively, the reversal of offshore manufacturing.
Dry bulk is probably the least affected of the shipping sectors by nearshoring or onshoring because, for example, Chinese steel production is not primarily for export. In fact, very little of it gets exported. They're using it. The reason they're producing 50% of the world's steel is they're, putting up 50% of the world's infrastructure and real estate. Similarly with coal, they're using the coal. The coal goes where it's used, and which is for energy production primarily. So I think the container business is very greatly affected by onshoring or nearshoring. Tankers and dry bulk much less, and dry bulk maybe least of all.
Yeah, I would agree with Hamish, and I think you need to separate if we're talking about large consumer goods such as automobiles, which really has its own domestic demand and growing in China, versus producing iPhones. And if producing iPhones gets brought back to the US, that is not going to affect dry bulk shipping. China, I would still argue, is one of the cheapest areas in the world to produce steel. As Hamish pointed out, it's mostly used for domestic demand. And even some of the onshoring, if you will, countries like Vietnam have actually taken away some manufacturing over the last year from China, and they still need raw materials. So even if we do see a little bit of a shift to maybe some cheaper and more friendly, or at least perceived friendly manufacturing areas like Vietnam or Philippines or what have you, I don't see it negatively affecting dry bulk.
Mm-hmm.
Okay.
Okay, and then a follow-up question to that is, China is the driver of the steel and iron ore market. Can we have sustainable rates in the smaller sizes, poor Cape rates, if China cuts back on iron ore imports?
I think everything is highly correlated. I do think they have their own supply and demand, but in the end of the day, from Capes all the way down to handysize, they do over at least the medium term tend to move in the same direction.
Mm-hmm. Okay, moving on to another question, another topic. Most of the dry bulk world is still small, mostly privately owned companies with a handful of vessels. Is this model still applicable? And indeed, if you were asked by someone thinking about entering the market with a couple of acquisitions, what advice would you give?
That's a good question.
I would advise them to go into biotechnology.
Yeah, I think it's it's clear that today to be competitive, at least in the longer term, you can have a lucky punch. You can go in and out, and you may be successful in that. But if you have a going constant long-term strategy, you need to have a low cost base, and you need to be able to drive down the cost. You need to be able to grind out every cent on the cost side, as at the same time as you have eye on the technological development, as we talked about earlier. So I think we are moving away from that this opportunistic place where you go in and out. I hope as and when the entry barriers they increase, but of course, if you have the right hand and you do it at the right time, there's always money to be made in dry cargo.
Yeah, look, the barrier to entry that is becoming higher and higher is the cost of financing. The European banks just want to lend to the larger companies. The Chinese leasing houses and the Chinese banks, will lend to players that they know in China and to big players outside China. It becomes harder and harder for a small shipping company to get debt finance. Now, if you don't need debt finance, maybe you do okay, but your cost of capital is going to suffer.
Yeah, I think
okay,
that,
thanks.
I don't think the asset play has gone away by any stretch because of the fragmentation, but I mean, it's just harder and harder to raise capital, whether it's equity capital or debt, as Hamish pointed out. It's becoming more expensive. We've been talking about this for at least a decade, if not longer, and all of a sudden here we are, where financing really is becoming more difficult for the smaller companies. Dry bulk, we're not there yet, but we clearly are having to become more sophisticated in terms of dealing with the regulatory environment, as we talked about before, decarbonization coming, and just being more efficient in general on the cost side, on the fuel side, and I think it's more difficult for the smaller players to adapt to that right now.
Well, let me step in, Andrew, here, and you might have a few more, but sort of to follow in on that. Each of you guys represent some of the largest public shipping companies. And it's not just true of dry bulk, but for certainly dry bulk and tankers, one of the challenges has been for the vast majority of shipping companies, they've traded below their net asset values, however you would calculate that, for a long time. And so the cost of equity is higher. I would imagine the cost of debt and access to debt is better as a public company, but certainly the equity component isn't cheap. It makes sense that there should be consolidation and whatnot, but without there being an advantaged cost of equity capital, I mean, are we just sort of in stuck in limbo here?
Well, as you point out, the reason to be public is to have access to the equity capital markets. There's no point having access to the equity capital markets if your stock is trading below the liquidation value of your fleet. So, yeah, I mean, every public company is there being public in order to have its stock trade above the liquidation value of its assets. And that's not the case right now. What does it take to make that happen? It probably takes a situation where a company can pay dividends throughout most business environments. And in order for that to happen, we have to be less leveraged. I think certainly Star Bulk is working on becoming less leveraged. I mean, we went into 2020 thinking 2020 would be a pretty good year. And what do we get? A global pandemic. Nobody expects a global pandemic. So hopefully we'll have a good year next year, and we can get that leverage down and pay dividends.
Yeah, I think Hamish is spot on. The only thing I'll add is that I do think these companies need to be bigger, and we gotta, max we should have 2 dry bulk shipping companies publicly traded, maybe even 1, but it needs to be significant. It needs to be 3 billion, 4 billion, 5 billion of market cap, lowly levered, as Hamish said, the ability to pay dividends and go through basically any cycle and keep that dividend going. And unfortunately, most of the dry bulk companies also have some concentrated ownership, so the liquidity factor is also an issue. So we do have some things to work on, no doubt, over the next few years.
Do you think that'll happen?
I'm cautiously optimistic, Ben, but we'll see. I think one of the biggest things is some of the larger shareholders and the overhang. We need to figure out a way to get more liquidity, in these shares.
It'll happen if we get 2 good years.
2 good years. That's what we're shooting
All
on.
we need.
Sounds like the title of a book. All right, good. Andrew, were there any other questions that you'd had?
Yeah, thanks. So a related question: if you were to look at a large transaction, say around 300 million fleet acquisition, which finance route would be your first choice? Equity raise, bank debt, Chinese lease, or a mix? You get that?
Not everyone at once.
Look, I would tell you, from Genco's standpoint, we've got a significant amount of cash on our balance sheet, so we would focus most likely on bank financing. We like the bank financing markets. We get competitive rates. It's a very simple capital structure, which we think bodes well for investors. I would have a hard time saying for a $300 million acquisition, you'd want to go out and raise equity with where anything is trading today. That doesn't make a lot of sense to me.
Yeah, I mean, the way we would approach it would be the way we've approached our recent acquisitions, which would be to issue shares to the seller of the ships valued at NAV, and issue some cash, and not change the leverage of Star Bulk really at all, but increase our market cap, hopefully increase our liquidity, and increase our public float as a percentage of the shares outstanding. Without changing the risk profile, without levering up the company.
Okay, Andrew, if you want to, we have just a few minutes left, and I was hoping that we could get the poll results in before everything is concluded, but we need to have the second poll. So same question as what was asked at the beginning. We'll see if the answers are any different. How many of you in the audience believe that the dry bulk market has bottomed is the question, and hopefully, Andrew, we can put that up.
Okay, I'm gonna launch the poll now and leave about a minute or a minute and a half for the audience to put their answers in. So that's being launched right now. You should see it. In the meantime, just a few more questions from the audience. Why has there been so much volatility in dry bulk shipping shares in the last few months? And do you feel like your investor base has changed since COVID-19?
I think now I can't see the rest of the participants, but I'll start speaking. I think with regards to the volatility, I think there's been, of course, up until about a month ago, a question mark hanging over, of course, COVID and how quickly the demand situation could come back on track. And I think that has exerted a lot of downward pressure. It's not many weeks or months ago that there were talks about the liquidity issues throughout the industry. And I think as this has evaporated over the course of the last 2-3 weeks, and we are getting a better understanding of where the rest of the year will be, I think this has had then again an upward pressure on the shares, and thus in turn given quite a volatile ride. But I think shipping in general is not for the one with a fainted heart. So volatility is inherent in the shares, of course.
Yeah, and dry bulk shares historically have been much more volatile than the S&P 500. I think our share has over several years been about 5 times as volatile as the S&P 500. So this is not a surprise when the S&P 500 has been as volatile as it has been.
Yeah, I mean, there's a pretty decent correlation with freight rates, and let's face it, we went very low in end of March. We came back a little bit, and then we went back down to $2,000 a day, and now we're coming out of that at 14, 15. So the volatility to me is unfortunately to be expected.
Thanks. The results of the second poll that we just did, we had a 54% participation rate and 61% has bottomed out, and 39% thinks that it still has some time to go. The first poll that we did in the beginning of the session, we had a 59% yes and a 45% no, so fairly fairly consistent. So just one last question from the audience before we close. Is the recovery going to be seasonal, like it has been for the past several years, or durable?
It will be durable and seasonal.
Yeah, I agree. Exactly. Couldn't have said it better, Hamish. Next question.
I'll ask, are you guys at all surprised at the poll results there?
I would have been hopeful that we would have moved the
a little bit more.
We moved it 2%.
Points.
Yeah, well, an hour is maybe not enough time to convince people, I suppose. But.
We gotta shave up next year.
Or it's just too long, and I'm not sure which.
Good. Well, I don't know. I'm feeling that maybe the advice that I was given that we're all going to stop using electricity and driving cars is not going to pan out after all after this discussion here. So I don't know. We'll see. But Andrew, we have a minute more. I can keep going unless you want to keep the schedule tight.
Okay. How about one last question? What's the future of dry bulk? More or less.
Not to be too broad, but
bright.
Yeah.
Okay.
The question is actually, what's the future of dry bulk, given that in the next 5 years, a lot of the market will be choosing cleaner energy, and thereby coal movements is shelled out. With that environmental perspective in mind, what would you say is the future of the dry bulk shipping?
I don't see coal going away in 5 years. Again, I think there's a shift from Europe to Southeast Asia. Longer term, when we're talking 10, 15, 20 years, yeah, then I do see coal starting to be phased out. But at least for the next 24 months, we have a positive and upwards trends outlook for dry bulk shipping, which based on everything we already talked about today on the demand side as well as the supply side.
Yeah, and again, I think the environmental regulations are going to prevent ship owners, even if they have the money, from ordering ships because they don't know what kind of fuel and what kind of engine they're going to need in that ship. And that is a strong positive.
Well, one for me that I've asked in dozens, maybe hundreds of panels over the years. You're given $100 million, or fine, you feel like you have an excess $100 million. Do you buy back shares, pay out dividends, buy assets, pay down debt, keep the cash? What's the best use of the incremental $100 million, which is a problem that all of us struggle with? So.
Yeah, I think in Golden Ocean it would be a combination. I think we see the asset prices having bottomed out. I think it would be wise to take advantage of that. On the other hand, I think our shareholders have also suffered with us, so I wonder if we would find room for a little bit of dividends as well. So probably a combination of that, and then keeping a little bit for a rainy day. That I think would be our capital allocation.
And we have a dividend policy we put in place last November, and if we got 100 million of fresh cash, from some benefactor, I think we would keep some of it under our existing dividend policy and pay a bunch of it out.
Yeah, I look at it as a combination. I think we still want to make sure that we maintain high liquidity, so we would probably keep a little bit of it on our balance sheet. I think dividends are, particularly as leverage continues to come down, we talked about it before, are very important for this industry in terms of returning capital. Share buybacks, they look compelling, but the reality is they haven't worked. So I'm going to table that at this point. And I do think asset prices are attractive from an entry point right now.
Yeah.
All right. Great. Well, we've overstayed our welcome by 2 minutes here, but I do want to say thank you all for putting up with me, and also Mike and the whole team at and Matt and everybody else at Marine Money. Again, thank you for having me again, and hopefully this is helpful to all of the people listening in the audience. And Andrew, thank you for your help along the way here as well. So.
Yeah, thank you very much, Benjamin, Hamish, Ulrich, and John. For those of you listening, this webinar is being recorded and will be posted on our website later today or tomorrow, so keep an eye out for that. We will also be sending a follow-up email tomorrow with some contact details, so if your question wasn't answered today, you can follow up with our speakers tomorrow. Thank you very much again for tuning in. This is your host, Andrew Oates from Marine Money, signing out.
Thank you.
Thanks.